Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have Annie Dean, head of Team Anywhere at Atlassian, Michael Romer, managing partner of Romer Debbas, John Wirth, executive vice president of research and investor outreach at Nareit, and Rohit Vohra, head of global wealth alternatives at Principal. They join me to discuss commercial real estate capital markets performance in REITs and distributed work trends for 2024. It is great to have all of you with us. Welcome to Trade Talks. And let's start off and talk about this impact of employees returning to the office, distributed work models, hybrid work models. What does it mean for commercial real estate? What does it mean to retail? What does it mean to the office in general, Annie?
It's a great question. So at Atlassian, we have a program called Team Anywhere. We are the largest distributed company in the world, and we are 12,000 employees who get to choose their working location every single day. So that means that we used to be in the US, concentrated in places like New York, Austin, and San Francisco, and now we have about 40% of employees globally who don't commute to an office. And that has huge gains for individuals. The saving in commuting time alone gives them 5 weekends worth of time to invest in their families, local communities. We're seeing strong results related to productivity and company performance. But it does make a difference to how we live day to day in New York City. I'm a New Yorker. We're in Times Square today. Normally I'm working from my home office in Soho. I think the big thing to keep in mind here is that distributed is non-controversial. It's just a word that describes how most work happens today, which is online. And I think it creates huge opportunities to create impact beyond the 4 walls of an office or the confines of a single city. We can now see that the financial sector in New York, for instance, has extended down to Miami, and that there are really great ways to connect sort of our physical presence across the eastern seaboard in terms of impact and performance. So for me, a really exciting opportunity that as we look towards the future.
Michael, take the other side of this, because there is a trickle-up problem too.
It is a problem. It's a problem that's near and dear to my heart, and it's something that we've talked about before. As a real estate attorney here in New York, if I don't believe in the concept of return to office, who will? You know, there's a value to remote work, but it comes at a great expense. And that's the debate that we're really having too. And it's great that somebody can work remotely, but who's going to pay for it? And what's happening now is you're looking at buildings, at least here in New York, you've got an occupancy rate of 50% in some cases. So you have these buildings, these office buildings that in some cases are close to half empty, but you have landlords that are paying substantial mortgages. So the trickle-up problem is, let's say I want to cut my space in half or potentially vacate the space I'm in. That rent doesn't go to the landlord. The landlord's then in a problem, the scenario where they can't pay their mortgage. And then ultimately, the Armageddon is the landlord says, okay, bank, here's the keys on an office building that's been devalued in some cases by half. That's the real problem that we have, and it's something that it really impacts, especially, I would say, the B office buildings in cities like New York. It's a challenge, but it's something that we all have to look at because there is another side. In some cases, comfort can be blinding, right? Everybody loves to have the ability to work from home, wants to have that freedom, but it does come at a great cost.
Mm-hmm. It certainly does. And John, what's the impact to the REIT space? I mean, there are some winners and losers here.
There's definitely winners and losers, and I think this question of quality is really important. The quality of the office is really been quite determinative in how they're getting valued. REIT properties, by and large, are high-quality Class A buildings. They're generally going to be the winners in the winner-loser across the quality divide. REIT office stocks have had a tough go since February 2020. Should note they're up 40% since the beginning of October. So the combination of the rate cuts or coming rate cuts and more accommodative policy from the Fed, as well as I think some change in sentiment around how high quality office is going to perform, I think we're starting to see that.
Mm-hmm. And Rohit, when you think about it, it's all about debt when it comes to commercial real estate, and part of the issue is that the lending model is very different now as well.
Yeah, I think to Michael's point, the occupancy rates are still pretty low. In terms of actual people in the office, the numbers are below what they were pre-COVID. And with that, you see the net absorption rates are still declining. So it's going to be challenging for both equity investors and debt investors. And from our perspective, I think it's going to take some time to clear these. From a capital market perspective, capital markets have ground to a halt because of the uncertainty. The equity guys, in some cases, don't know what to do with it. If they go back to hand over the keys, the lenders are like, what are we going to do with it? So they're all trying to find a solution. But as of now, we are in that zone of discovery, and there is no clear answer today.
Yeah, with interest rate policy loosening up a bit here and projected 75 basis points of a cut next year, does that mean anything for the commercial real estate space?
It means everything.
Yeah.
This market is in demand for interest rate cuts. Now, hopefully this happens, because what we've seen in the last year are regional banks just not lending. They can't do it. And it's too much pressure on the regional banks. And it's really impacting the overall real estate market, especially the commercial real estate market. You're looking at drops of transactions, and it's trickling over to the residential side too. Your volume's down probably half of what it was a year ago. Commercial's a whole different story, and people are just waiting to see what the new normal is. Everybody's been talking about rate drops, but we haven't seen it yet. And time will tell, but the market desperately, desperately needs rate cuts and more importantly, rate stabilization, so we know what the new norm is.
And let me ask you a question though, and I don't want to sound flippant here. As the employee, is it our problem that people are over-levered? There's a lot of debt on the balance sheet. If it's private equity or banks that are losing money on this, I mean, they have a lot of money. I'm more selfish about my work-life balance.
Right.
And I realize there's give and take with both of, to Michael's point, it does trickle down. If we're not in the offices, we're only here 2-3 days a week or remote altogether, that impacts retail. It impacts tax revenue for the cities, which New York and San Francisco have been very vocal about, not being able to, and they desperately need the revenue. I mean, what's your thought as an employee?
Well, I think it's interesting how important the link is between the bill that becomes due for lower occupancy in offices. And at Atlassian, we are finding that as we project our needs forward, we'll probably need 50% less real estate than we needed pre-pandemic. So this is a real phenomenon. And so much of the return to office conversation feels protracted and like it will take many years to reach a conclusion. And in part, that's because businesses, landlords, commercial lenders all maintain this unknown interest for several years into the future. Hey, we tried return to office mandates. Employees didn't like it. They didn't comply with it. Our return to office kind of trend lines in terms of how it impacts occupancy has remained flat over the past 3 different kind of Labor Day events, which is when you kind of look at this return to office moment to see whether or not these mandates are sticking. And so I think that we're going to see that the behavior becomes durable across the employee set, and that's going to result in a different contracting cycle in the 5 to 8 year timeline when office leases become renegotiated. So I think that my key message here is that these are really linked, and there are interests on both sides that are going to take years to resolve.
Yeah, Michael, John, let's take it from a macro perspective here. Let's call it the past 15 years. The system was flush with liquidity at historically low interest rates. I mean, there was really no risk associated with it, whether you're talking about the REIT sector or elsewhere. And I think there was no blueprint, there was no risk modeling for a pandemic. Certainly, no one was modeling that in 2019. So how does this impact a space like the REITs as you're coming from 0 interest rates to 9 months of I mean, we go up 500 basis points, and now we're thinking about coming back down. Where do you see the opportunities here? What's been impacted? Where are you looking next?
Yeah, we think there's tremendous opportunities out there, both in the public real estate, the REITs versus private real estate. Public REITs have really priced in higher interest rates, nearly 100%. Private real estate is just in the early stages of those valuations. So for institutional investors, we're seeing a lot of interest in tactical movements between their private real estate portfolio and a public real estate portfolio. The other thing is, REITs have really been on the leading edge of taking that valuation decline because of higher interest rates, despite the fact that they actually have very well structured balance sheets. And they've been on the leading edge of the recovery, not just over the last couple of days, but really over the last month and a half. We've seen REITs up over 20% since the beginning of November. And I think that is reflecting the fact that in a lower interest rate environment, or even in a stabilized interest rate environment, they can perform very well.
Yeah, and Rohit, it's not the same outside of the U.S. Return to office is different elsewhere.
Yeah, I think it's a US phenomenon largely. Europe and Asia, a return to office is well underway. If you look at vacancy rates here, it's about 20%. If you look at vacancy rates in cities like Tokyo or Seoul in Asia, it's roughly 5%. If you look at Berlin, Munich, it's roughly 5% again. So I'll say it's a predominantly a US phenomenon, with Europe and Asia farther ahead in return to office. I also wanted to come back to one of your earlier comments. It's interesting you brought up, should the employee care? And we are a capitalistic economy. I don't think so employees will care or should care. The capital markets are the ones who will sort this out. And to Annie's point, it's a 5 years, 7 years. I have no crystal ball to tell you how long it will take. But there will be repositioning of these assets to respond to the new demands. I'll give you one example. Office right now is deteriorating. We have no idea when it will hit rock bottom. But what has happened since COVID is the demand for data centers have taken up because our consumption of data has gone through the roof. So if you look at the data center market, vacancy rates are the lowest since the record is being kept. It's less than 2%. So there is an opportunity that some of these buildings could get repurposed into data centers. So there is going to be a repositioning of these assets if they cannot be consumed as offices. And that restructuring is not going to happen in months. It will take multiple years. But capital markets, reallocation of capital, some will be winners, some will be losers. And in a few years, you will have a totally new setup to accommodate this type of work environment.
Yeah. Michael, do you think the city is approaching it correctly? Is it thinking of ways to enhance the economy or think outside of office revenue?
I've always felt that the city and the government in general, whether it's local, state, national, should be encouraging employees to come back to the office more, because the economy really needs it. Because then there's a spin-off economy too. The employees that come into work every day, well, they're going to the local bagel store, the local sandwich shop, the local coffee shop. And if you walk around here just in Midtown Manhattan, you'll see a lot of these stores are closing. Just in the last year, the block that my office is on, we lost 2 coffee shops, 1 sandwich shop. And that's a problem, because these are other businesses that rely on the employees coming in to buy that overpriced $7 cup of coffee. But it's just something that we have to face. But there is a real impact on the smaller businesses and the small business owners, because they rely on the employees. I couldn't agree more on the need for data centers. I think we're seeing a lot of that all throughout the country. The problem is there's just far too many office buildings to repurpose. And most of these buildings have big, substantial loans from commercial lenders. And it's a real threat to these banks, because ultimately, what are they going to do with those loans? And that's really the true problem that is beneath all of this. I am all for the concept of remote work and the ability to do it, but it comes at a real cost. And that's truly what I'm afraid of.
Well, it's interesting, actually the panel before yours, we also spoke about commercial real estate, and my question to them was, okay, so if we have 50% of office spaces available, well, there's a lot of homeless people, there's veterans that need homes, affordability is certainly an issue in the city. Why can't we just do it? And it's been widely spoken about, but it's not that easy. Floor plates, plumbing, there's regulations when it comes to how much light and zoning. It could be a 4-year project, and you know, the debt holders might not want to break even on this, right? Especially with values that are coming down, the money that they actually have, it costs more to build. So it's not as easy as it is, okay, like look at this big open space we're at, you know, in Midtown Manhattan, it's a giant circle, let's put 4 walls, we have 4 apartments. Right. It's not that easy.
Well, and I think it's interesting too, because you want to put business owners in a position to make good decisions about their real estate and their offices. And I think right now what we see is a little bit of a knee-jerk reaction. Everyone come back to the office, or we're going to try to pay to exit all of our real estate. We're kind of treating it like a zero-sum game. I think one of the things that's been important at Atlassian is that we've been able to make dynamic decisions about our real estate that allows us to transform it over time and reinvest into new markets. And I think, you know, for us, we've been looking at something called cost per visit. So we understand, what does it cost us as a business every single time the office is visited, since all visits are, you know, voluntary. Whenever people want to show up, they can. And as long as we maintain a cost per visit below a certain threshold, we know that we feel good about our real estate. We also look at occupancy, and we treat our visitors like users to say, how frequently are they coming in? Where are they coming in from? And I would love business owners to be equipped with these types of metrics that would enable them to make decisions that result in office holdings that are substantial, because an office is a very important part of a distributed company and culture, and not look at it as, we can only have a culture if we have everyone back in the office, or we're going to let go of everything because everything should be remote. I don't think that's the right solution for cities or for businesses.
I think we can all agree that the hybrid model is the ideal model, where somebody comes in 3 to 4 days a week and is remote 1 or 2 days. But the distinction I make with that is, let's say a first-year employee versus an experienced partner level or a senior employee. There's a big difference there. You lose that ability to train. You lose that camaraderie. We were talking earlier. There is an out of sight, out of mind piece to this too. If somebody's not in the office, I am not going to go click on a Zoom button and ask them something about a deal. And that's a problem. Maybe it's because I'm old school and that's how I'm wired. Maybe it's because the legal profession is different, because there are professions that the remote model works. But in a profession such as mine, that interaction, that camaraderie for training purposes is invaluable.
As a real estate attorney, I loved remote work even then. That's how I started my career. But I do think this is all about building new habits for the future. And I think we should remind people that as long as we're intentional about our approach, there's no reason that we can't get to the exact same outcomes that we had. This is really the next step in digital transformation. It was hard to go from, taking handwritten voicemail messages to email to Slack to all of these different communication tools. Figuring out how to work across a distance is just the next phase of that change, and I'm confident that we will build the right behaviors there.
But I do think the jury is out on whether we're going to see productivity gains or declines from widespread work from home. And I think the other point that we need to keep in mind is, just because people are working 3 days a week from home doesn't mean that you need just 60% of the square footage. We're seeing a lot of organizations, the days they want people in, they want everybody in to get that in-person collaboration, mentoring, training, relationship building. And so that line between how much you work from home, how much less real estate you need, all of this is, I think, to be determined. We were talking earlier, we're in the early stages of a natural experiment that we're all living through. And what we're learning now is going to inform what we see over the next 5, 10 years. Yeah. But I think we're very early in what we know.
I mean, it's only been just about 4 years, even from an academic perspective. Your data set really is. I mean, you just don't have enough time to analyze that. But I will say, I think it is admirable that everyone's thinking about this in a deliberate way and not an either or. It's not a zero-sum game we're trying to figure out, because we were talking about this off air. Somebody had mandated 5 days a week, and they had a big problem with attaining and retaining employees. And again, we have a super strong labor market. That could potentially change should the balance of power shift there. This recession everyone's been talking about for the past 18 months hasn't materialized. We don't know what the labor market's going to look like, but what are we at, 3.7% employment right now? If you want to work, you have a job, right? So I think that would be like the next catalyst to see how this model evolves.
Yeah.
The biggest challenge for New York is the concept of commuting, right? You've got plenty of people living in the suburbs that live in nice homes that are close to the city. They can hop on a train, and now they're saying, wait a minute, why do I have to do this, right, when I could work from home? And that's the challenge, because we do actually have to commute in. You have some other areas where it's easier to get in, so coming back to work isn't as big of a problem, because the incentive to stay home isn't as great. But if you live an hour and a half outside of the major city,
as we do,
the incentive is different, because that comfort that I spoke about in the beginning is greater if I could just stay from home and I should not have to commute. But the big question is, who gets to make that decision? And that's something that we've talked about a little bit. Who gets to decide where the employee is more efficient? And there's different schools of thought and different research on there. I can only speak to it from a business owner standpoint. The people that are generally coming in are having greater success than the people that we see less.
Yeah, well, I mean, to your research, Rohit, ex-US, you're seeing different trends. I think part of that is, we all travel internationally. There's reliability on public transit. It's certainly safer. The cities are certainly cleaner. And I think that the city, particularly New York, has to take some ownership with that.
And then you brought up the unemployment rate. I have no way to prove it, but maybe the labor markets are so tight because people have the flexibility to work remotely, and people who might have said no to a job if they had to commute in are now saying yes to a job because they don't have to commute in. So there is also that at play, and to John's point, we won't know all these things which are true patterns that have paradigm shifts for the next few years till this experiment plays out completely.
Yeah. I mean, that's a great point, and I've never looked at it from that perspective. I mean, we saw what happened in the beginning of COVID, where women were the ones to leave work first because multi-generations to take care of at home, kids to take care of at home. We know childcare is crazy in the tri-state area. A lot of times it was cheaper to have one or the other partner stay at home than it was to pay for daycare, pay for commuting. You break even at the end for stress.
Right.
Exactly.
So
one interesting stat on that, I love the idea that there's a more liquid job market because you can, fill roles that are no longer restricted to place. And at Atlassian, given that we have this distributed model and accommodate remote work, we see that we have 2 times the number of applicants per open role since we've instituted this model. And I do think that that speaks to, the fact that people from more locations can apply to these roles.
all right, and we'll leave it on a positive note. Appreciate everyone's insight. Thank you for joining us on
Thank you,
Trade
Jill.
Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.